Hi, I'm David Gallagher. I'm the CEO for the Centre for International Finance and Regulation. Today we're speaking with Professor Russ Wermers from the University of Maryland, who's an expert in investment management and mutual fund performance. Welcome, Russ.
David, it's my pleasure.
Maybe just kicking off, can you give us a bit of background about how you got started and interested in finance before you got to your PhD at UCLA?
Yeah, sure, David. It's kind of an interesting story. I think the whole tale begins probably in 1978 or so, ancient times, these days, 38 years ago. I was an engineering student, and I had an elective I could take. Engineers don't get many electives to take. They have a lot of required classes. And as I was looking for an elective class, and there was a macroeconomic class at the undergraduate level, just simple Econ 101, if you will. And somebody said, hey, this instructor is great. You should take him. So I somehow managed to finagle into this class. And the guy's name was Barry Asmus, and he was just terrific. It just lit a fire with me. So the guy, turns out, I checked on this guy, turns out that he's one of the top 5 motivational speakers in the United States now, so he's really made something for himself. But I kind of set this ambition aside about economics and my love for it. I continued with my engineering degree, but ultimately was drawn back to it through my business experience.
And what got you interested in the mutual fund area, and who were the sort of influences in your thinking in terms of that research?
Always interested in asset management and buy side. I thought maybe I would be a stock analyst in the energy industry at one point when I was an MBA student. That didn't work out. When I started my PhD, my mentors, my advisors, Sheridan Titman first, and then Mark Greenblatt, were pioneers in the field of investment management and measuring performance and coming up with innovative ways to do so. So I got to know Sheridan as an MBA student and became his RA on my first day of my PhD program. And that's what he set me to work on, was a project on investment management. So I guess I've never looked back.
And you've published in all the top places in finance and economics. What are some of the research papers that you feel that you've been most significant in terms of your contributions, and why is that?
I guess my 2000 paper that looks at, does a long-run view of investment or mutual fund performance management, and looks at holdings versus returns and tries to figure out, decompose from the top down, from the holdings down to the net returns, where the returns go. I'm sort of proud of that. I think that opened up a body of research. Recently, I think I'm really happy with this money market mutual fund run paper that's being published in the American Economic Review sometime this year or next year, that describes what happened during the crisis to money market funds. So those are 2 things. But to be honest with you, David, I think the crowning achievement, I think, in my mind, is my textbook. To me, this is very important to say to the world, or to have the world, believe that I've done something of value for the practitioner, for the professional, and the textbook, I think, does that.
We had a recent, someone in our field, Gene Farmer, a recent Nobel Prize winner in efficient markets. What's your view about market efficiency, and how efficient are markets?
Yeah, that's a tough question. I would say that markets are efficiently inefficient, if you will, and let me define what I mean by that. Is that it kind of depends on the market you're in, the sector of the market you're in, how competitive that sector is, which sometimes goes hand in hand with efficient markets. So there are some areas in the market. I think your question is best answered by that there are some areas in the market, like large cap core stocks, that are very, very efficient, and it's hard to find an edge in those areas in the market. There are other areas in the market, such as high yield bonds, such as private equity, such as hedge fund investments, some of the anomalies out there that I think are less efficient. Overall, I would say that the market is becoming more and more efficient over time, because the cost of gathering and processing information has decreased substantially over the last few decades. It's definitely a secular trend that's going on.
So the active-passive debate's been waged for 40, 50 years or so. Who's winning that debate?
I don't look at it as a matter of somebody winning or losing. I think both types are needed in the marketplace. I think the equilibrium is moving more toward passive management now, and it's all hand in hand, I think, with the decreasing cost of gathering information. To make a market efficient, again, it depends on the sector of the market, so I'm qualifying my statement here. But to make the market efficient, it takes fewer active managers today than it took 30 years ago. They're just quicker, they have better computers, they have better training, they have better research, better data, another thing. So I always think that both are necessary in the market. Passive managers are there to take advantage of the efficient markets and to provide low-cost access to investors. And active managers are the guys who make it efficient and collect some rents from the passive managers. Together, they make the markets go.
So Russ, in terms of the fees that are charged in asset management, obviously passive fees are a lot lower than active fees, but how is it in terms of performance that active managers can beat markets after their fees? Are the fees commensurate with the performance that they generate?
I think they are for the average active manager. I'm not sure that they are for the left tail of active managers. And let me comment about the fees for passive managers. They've been coming down enormously as well. So they've been benefiting from a huge reduction in the scale of costs for even for indexing and for processing transactions and for processing and communicating with your clientele. So that's been leading the way, and then active managers have had to follow suit. The whole thing is driven, though, I think, by just this enormous efficiency in technology that has happened, that has hit the investment world as a whole. To more directly, I think, address your question about active management net of fees. Active managers, part of I think this efficiency in technology is it's a lot easier to find out if your active manager is actually beating a benchmark or a passive alternative. And so investors are demanding to get their money's worth. If they don't, they'll go to a passive fund or they'll go to an ETF, which provides another avenue for them at a low cost.
You've published a lot of research that's used a lot of different techniques, risk-adjusted techniques in terms of measuring a fund's alpha. Indeed, you've come up with a new measure, the Daniel Greenblatt, Titman and Wermers measure, which is a risk-adjusted measure that is at portfolio holdings level. Do you think the industry is using sufficient measures to determine the ability of asset managers in evaluating what they do for clients?
I think the private industry is. I think that where things are lacking are the tools that are being created or have been created for the public, the layperson, the retail investor are sorely lacking and are way behind. I think the technologies that myself and others have created. In particular, using portfolio holdings-based information. You just referred to one of my papers, but there are many, many others of myself and many, many notable papers of other authors who have done some amazing things with portfolio holdings information. I'm a bit, I guess, distressed or a bit disappointed that Morningstar and Lipper have not picked up on this yet, or some other information intermediary. I think a lot more can be done with portfolio holdings. And I mentioned at the conference as well, macroeconomic information. More can be done with macroeconomic trends and how that affects how well a particular investment manager or sector will do. So in general, I'm a bit disappointed in what's available in the public arena, but I'm sure that in the private arena, the pension funds, the hedge funds, the more sophisticated institutions are definitely using these types of techniques.
And what about hedge funds? I mean, hedge funds are a bit of something that we don't really know a lot about because there's a opaqueness to how they operate. Yes, they are needing to disclose information, but they're quite sort of diverse in their operations. What would be the best strategy with a hedge fund? Is it better to invest in the hedge fund, or is it better to own shares in the hedge fund company?
Well, I think there's a trend going on now in hedge funds, in those sponsors of hedge funds. They're demanding more transparency. My guess, it hasn't happened wholesale yet, but my guess is that hedge funds, the better hedge funds, the ones that want to keep their clientele and build their business, are probably going to have to provide a lot more transparency about what they're doing, their strategies, their holdings, things like that. So I think those that do that, there'll probably be a separation. The good hedge fund managers, the ones that have skills and have a strategy, that really make sense will disclose, will become more transparent, and the rest will probably not stay the size that they are. So I think the hedge fund industry is probably going to go through a rationalization period where many disappear because they're not providing value.
And in terms of active management generally, what in your view are the strategies that seem to work best, that consistently seem to deliver alpha? Is it value? Is it growth? Is it small caps, large caps, or is it a whole mixture of those things?
Well, I think it's the general tendency. I've seen it happen in all areas of the market, but the general things that I've seen, the general trends and rules of thumb that I think I've developed are that you want to look for active managers in areas of the market that are hard to invest in. And this can, again, mean anything from high yield bonds to emerging markets, to small cap stocks in the United States, or to internet stocks during the dot-com bubble, financial stocks during the financial crisis. That's kind of the general rule you want to use, is look for an active manager, look for a skilled active manager that it has skills in the area that is most, say, disruptive, I guess, the area of the market that is being disrupted the most and has the most asymmetric information or could have the most differential outcomes for different companies.
There's a lot of smart people that work in asset management, and obviously they're well paid for what they do. Do you think there's sufficient alignment with the fees that are charged and the value that's created for investors?
Perhaps not in the public space. I mean, I would like to see more in the mutual fund space, more incentive fees. But it's hard to do correctly because incentive fees can also create incentives to take risks if they're not done appropriately. But I would like to see incentive fees and things like that are done in the corporate world, where corporate executives, their compensation is now being tied more to long-term stock performance. I would love to see that type of tendency happen in the mutual fund world, where a mutual fund manager, his compensation or some of his equity share is tied to his long-term performance, like 5 or 7 or 10-year performance.
In the developed world, we have pension plans, and they're obviously getting bigger because people are saving for their retirement. Australia's the same. One of the things that we've noticed here and has been in a recent inquiry is that fees haven't necessarily been coming down to at the rate that investors have sort of been expecting. Given that assets sizes under management are growing, do you think that there's a sufficient ability to put downward pressure on fees, or do you think that there's something that can be done about that?
Well, I think in the U.S. that's happening quite a bit. It's happening through the courts. It's happening through the SEC requiring more disclosure, more upfront disclosure of fees, and exactly giving the layperson some tools to understand very, very simply how an extra 50 basis points per year of fees will affect their retirement savings 30 years from now. I see a huge amount of competition in the United States. I'd like to see more elsewhere. This comes with disclosure. This comes with regulators requiring more transparency and things like that. It comes with competition as well. There are few markets as competitive as the United States, and some of that is due to the structure of asset management in the U.S. versus that in Europe and Asia.
We're living through an age of technology disruption. What do you see in terms of disruption in asset management, and what sort of products and services might we see evolving in the next 10, 20, 30 years' time?
ETFs might give us, I think, a hint about what's to come here. I think there's going to be a lot of do-it-yourself investing where you do not rely, and I'm talking not just about retail investors, but I'm talking also about pension funds and endowments. There are a lot of pension funds and endowments that are now debating whether they should insource a good deal of their operations instead of paying an active manager a large fee for this. There are going to be a lot of do-it-yourself products, and with that, I think will come more of a rationalization of fees. What form these products will take, we can see ETFs with underlying baskets of securities. Maybe there will be other synthetics and things like that, but I think that's going to be the general trend in markets going forward.
You mentioned earlier when we were talking about the advances in the industry, and that there's much more transparency and much more access to data. Do you think that that's only going to increase? And in terms of regulation, what are the types of data and regulatory oversight do you think the industry needs?
Well, some of it's happening. The SEC is requiring now mutual funds to disclose portfolios monthly rather than quarterly. the SEC is also requiring funds to think about the liquidity in their portfolios and to actually report to the regulator what fraction of their portfolio they can liquidate within a day, within 7 days, things like that. So I think going forward, these are trends in the right direction. The more we know about, especially I think about separate accounts and pension fund managers, the more we know about that and make that data available so that academics and others can make use of it and do good studies for the public good, I think the better off we'll be.
There's obviously gaps in research that haven't been done in our space in asset management. What do you think are some of the key areas that you think you expect to see research done, and what are perhaps the inhibitors to research not already having been done in that space?
Yeah, there are a lot of those, David. There are a lot of places that are lacking. I think the most obvious is fixed income markets, fixed income bond management, as well as the transparency of fixed income trading. There's a real problem. You would think in the U.S., being a huge fixed income market, that it would be easy to figure out whether you're getting a good deal on a transaction. But not so. So I see that as an area that needs an enormous amount of study. Private equity, there's no data. It's another area that we could use a lot of academic study and study by professionals who are savvy in this area. Hedge funds, there's not enough data. There's becoming more disclosure now through Form PF in the United States. That's disclosure only to the regulator, but at least that will allow some studies to be done, at least within the regulator's sphere. So that's just within the U.S. So there's just a lot of stuff, I think, out there that needs to be examined. I think basically anything outside the equity asset management industry is an area of fertile interest, I think, for academics.
You mentioned the importance of having a healthy industry, the asset management industry. It relies on having good competition, good transparency, and those kind of things. As you would probably agree, we need good regulatory oversight. In your view, both in the US and internationally, do you think that we have pretty good regulation when it comes to the asset management industry? And if not, what could be done to improve it?
Yeah, that's a good question. I think markets are evolving so quickly that it's hard to say. I think the SEC has come to the realization in the United States that markets are moving so quickly, and asset management, the landscape of asset management is changing so quickly with the advent of ETFs, with the fragmentation of trading markets away from the New York Stock Exchange. I think they're realizing that they're behind the curve, and they are now trying to ramp up, trying to invest in technology, trying to hire more PhD economists to stay on top of this. So I don't think it's necessarily that we should just automatically assume we need more regulation, but we definitely need a lot more study and a lot more transparency to figure out if we do need more regulation. I'd suspect that, just from kind of bystanders' view, that since fees are so high in Europe and in Asia, I think there probably is some need for at least more regulatory oversight in terms of transparency, requiring disclosure, things like that. But whether there's more arm twisting needed by the regulators, I'm not sure.
You're not only a top scholar, you've got entrepreneurial flair, you've been a consultant, you've been an expert witness. How's that exercise, doing all those things, added to your research, and what sort of example is that to sort of other academics? Should more of us be doing these kind of things because it makes us better all-rounder researchers and academics?
Well, I hate to make a blanket statement because it's the field I'm in is asset management. It really lends itself toward doing all these ancillary duties and learning from asset managers. I'd hate to say that a corporate finance researcher needs to talk to more corporate executives. Maybe that's true, but I think I'm just in an area of the market like Pete Kyle. Pete Kyle, my colleague at Maryland, is in an area of the market structure where it makes sense to do some consulting, to talk to the regulators, to talk to professionals who are doing the trading themselves or handling the trading. So yeah, it's been incredibly enriching for me, and I would urge academic researchers who have the opportunity to learn from such experiences to do so, and to try to provide some good for the public from their research.
So Russ, you've had a great career so far. You've probably got 20, 30 years of more contribution to go, so probably halfway. Could you maybe impart some wisdom or advice onto what a young scholar needs to think about in terms of building a really solid, significant career as an academic? What are the foundational features, mentors, etc., that are necessary?
Well, I think that the young academic today has to be more aware of what's going on in markets on almost an up-to-date basis. When I started 30 years ago, and my mentors started even before then, you didn't really have to keep up with what was going on in the market. There were certain traditional areas of research that you could work on: dividend payout policy, capital asset pricing model. Today, it seems to make a difference, to make a notch in the academic world. You have to find something that is emerging, some issue that's emerging in the real world. That takes a bit of acumen, I think, to figure out whether what you're seeing is a trend in the world or not. So I would urge today's scholar. I think it's a good idea to have some work experience, for one thing, in some area where in the old days it really probably wasn't that helpful. Have some work experience and bring some of the intuitions about markets with you, and bring in something that you were interested in ex ante in researching before you even do a PhD. I think that's the key.
If you're an international scholar, not living and working in the United States, some people might think the tyranny of distance gives you a disadvantage, but any advice or suggestions about how to do top quality research work when you're, say, an international person from Australia or from Europe, etc.?
There's a lot of great things happening outside the U.S. now. For instance, the Luxembourg School is working with an organization to put together a comprehensive database of mutual fund holdings and information, similar to the CRISP database in the United States. I think that'll be really interesting for European researchers who understand those markets better to get their hands on that type of stuff. So I think in general, there are databases becoming available in Asia that are different. We'd like to see how do Chinese investors behave? How do they invest differently or the same as U.S. and European investors? So I think the chances right now are a lot better for a non-U.S. researcher to make it into the top journals with the unique databases that are out there, not trying to compete just with the CRISP U.S. stock database or mutual fund database with U.S.-centric academics.
And finally, Russ, citations of research are really important. They convey the significance of the contribution to scholarship, and they're certainly relied upon by universities in terms of university rankings and how they reward and incentivize their staff. Can you maybe discuss some of the other areas of making impact that aren't necessarily just in scholarship in terms of traditional citations?
Well, I mentioned my textbook, which I'm really proud of. And it's not a bestseller by any means, but I think scholars being able to get their work out in the terms of a monograph for industry, which several leading scholars do. Larry Harris at USC writes monographs for the CFA Institute. That's a great way to do public outreach. Another way is when the SEC calls for or makes a proposal for a new potential regulation. They ask for comments from the public, and I think academics need to be more involved in providing their feedback for what they see about the particular proposal being put forth. Those are a couple ways. I always make it a practice to talk to the media when I can. I'm very, very proud and prominently display how many media citations I have. I think that's important, to reach out to the layperson, whether it's through the Wall Street Journal or the USA Today or the Sydney paper. I think it's important to reach out to the public and to give them some of your expertise. We are in a large sense paid by the public, so I think we should provide something back.
Well, Russ, it's been fantastic having you out here in Sydney, Australia this week. Thank you for sharing your thoughts and insights, and we look forward to seeing you again soon.
It's been my pleasure. I hope it's again soon.